Hey everybody, this is Leaf with Adaptable Wealth, where we reject the view of wealth that focuses only on money and material possessions. Instead, we're redefining it as a sound, healthy, and prosperous state. I recently did a video about how the CPI was manipulated so that it understates the true increase in the cost of living. You can check that out by clicking on the link above or in the description below. But what good does it do to point out a problem if you're not also going to offer solutions? And that's what I want to talk to you about today. The good news is there are tons of ways to protect against inflation, so let's kick it off. The first way to protect against inflation is to build your skills. This is by far the best path to take in the long run, as you will command higher and higher pay in the marketplace over time, and you're almost guaranteed to outpace inflation if you develop the right skills. According to a study in the Journal of Macroeconomics, skilled labor makes just under twice as much as unskilled labor. You will also reduce your odds of being laid off, and even if you are laid off, you increase your chances of quickly finding another job as close to the same rate as possible, maybe even higher. The second way to protect against inflation is to ask for a raise. If prices are rising, it's common for wages to be rising as well, and asking for a raise is one way to protect against inflation. One of the costliest things for a company is employee turnover. The lost productivity that comes along with training a new hire is very costly. I've done several analyses on the cost of employee turnover at my current job, and once an employee hits the 1 to 2 year mark, the cost of losing them is much higher than giving them a 10% raise in most circumstances. Provided you've done a good job, you shouldn't have a problem getting a decent raise. Add in the fact that in some industries and some positions, wages are skyrocketing now. There literally hasn't been a better time in the last 10 years to ask for a sizable raise. Now, you may not get it, but it never hurts to ask. Just be prepared to explore other options should you not get what you ask for. The third way to protect against inflation is to change jobs. The days of working for the same company for 30 or 40 years is largely gone and has been for quite a while. If you're not happy in your current position or you've been denied a raise, it doesn't hurt to see what's out there. Currently, there are more job openings than in the past 20 years, led by healthcare and social assistance, professional and business services, leisure and hospitality, retail trade, and manufacturing. Better yet, it's common to be able to negotiate a raise when you take a new job. I've never changed jobs without getting at least a 10% raise. It can take several months or even longer to find the right fit, so I suggest you start looking now. The fourth way to protect against inflation is to start a business or side hustle. It's a great idea to have a side gig regardless of the inflation rate because it helps diversify your income. But if your main purpose for starting a business is to overcome inflation, then a product or service that is reproducible at little to no cost is by far the best. Notice I said reproducible, not producible. The original product or service may cost time or money, but all the other units are very low cost or practically free. Examples include software, video, audio, or anything able to be copied or disseminated via computer or technology. There is another benefit to starting your own business, and that brings us to the fifth way to protect against inflation, the tax code. When you earn employment income, you earn, pay taxes, and then spend. And the tax reduction strategies are limited to such things as 401k, flexible spending accounts, health savings accounts, etc. You place your money in these accounts and then you are told how you can spend your money, and in some cases you will actually lose your own money if you don't spend the contributions by a certain deadline. On the other hand, when you generate business income, you earn, spend, and then pay taxes. Under many circumstances, you can now write off a portion of your rent or mortgage for home-based businesses. Some meals, phone, internet, education, professional, and legal fees are also deductible. Hell, you can depreciate your car and other equipment like computers when you specifically use them for your business. The sixth way to protect yourself from inflation is to take advantage of credit card rewards. Now, cashback schemes are not good deals for 99% of people, or for what I'm about to talk about to actually provide a benefit to you, you must meet two conditions. You have to have self-control not to put crap on your credit cards unless it's something you're already going to buy, and the money to cover the purchase is in the bank right now. The first one that I use is the Cash App. I've actually kind of soured on this one recently because it's supposedly almost fully algorithmic, and their customer service reps are not able to help with many problems that can arise. The main problem that I've experienced is that all of a sudden, for no apparent reason, my transfers of money from my bank account will get denied for weeks on end. When it does work properly, They have some good coupons and cashback offers you can take advantage of. My favorites are the 10% in Bitcoin back at restaurants, 10% off groceries, and 15% off at 7-Eleven, which is where I get my gas, so I'm able to get 15% back on gas, which is awesome. A couple caveats here though. There is a max cash back amount of $7.50 per coupon, and you can only use one of each of those coupons per week. But all in all, when the algorithms work and I'm able to use the coupons, I save about $60 a month based on my spending patterns. Not a ton of savings, but I'll take it. My second go-to card is the Target Red Card. You get 5% cash back on your entire purchase no matter what. That's almost 3 times higher than 10-year Treasury yields at the moment. And unlike Treasuries, you don't have to wait several months to get the money. You get it at checkout. And my third go-to card is the U.S. Bank Cashback Credit Card. I get 5% cash back on 2 choices of utilities, cell phones, TV, internet, gym, and more. And I get 2% cash back on 1 choice of groceries, gas stations, and restaurants. I get about $20-25 a month in cash back just by running my kids' school tuition, my utilities, and my cell phone through this card. Total with these 3 cards, I save about $100 a month. And I must reiterate, I'm not spending any money that I wouldn't have spent anyways. The 7th way to protect yourself from inflation is to convert your variable rate debt to a fixed rate. As inflation increases, interest rates tend to increase as well to compensate lenders for the loss of purchasing power that they will be repaid in. If you have a variable rate loan, you will be at risk of rising interest rate and therefore rising payments. Depending on how your payments will increase under a variable rate versus the payment under a fixed rate loan, it may make sense to convert your variable rate loans to fixed rates to eliminate the risk of rising interest rates. Be aware that there will be upfront costs in such a conversion. To determine if it makes financial sense for you, you need to calculate what is called the break-even time and the return on investment. First, you calculate the total upfront costs, which include points, processing fees, appraisal fees, or pretty much any fee that is required for the conversion. Second, you calculate the monthly payment savings. This is the difference in the monthly payments between the fixed and variable rate loans, and it requires that you make assumptions about how and when the interest rate will increase on the variable loan. Third, you divide the upfront costs by the payment savings, and this will give you the number of months that it will take for the lower fixed rate payment to make up for the upfront costs. Divide this figure by 12 to get the figure in years. The 4th step is to calculate your return on investment, or ROI. To do this, you calculate the present value of the savings. For example, if you're going to save $300 per month starting in 4 years, you need to calculate the present value of that $300, then do the same for all of the future monthly savings and add them up to get a net present value. Once you have that net present value, you divide by the total upfront costs, and this will give you the return on investment. You'll have to determine an acceptable ROI for yourself, but I usually shoot for a minimum of 300%. In other words, if upfront costs are $5,000, then I want to get at least $15,000 in net present value savings. In general, if the break-even time is more than a couple years, it won't make much financial sense to do the conversion. For example, if you have 5 years remaining on a loan and it will take 4 years to break even due to the upfront cost, then your savings will be quite low, and so will your ROI. You may be better off taking the money that you would have to pay in the upfront costs and investing it in the stock market or something else that will grow your money at 7+%. The exception is if the time remaining on a loan is very long, like 20 years or more. If it takes 4 years to break even and the next 16 years is all savings, your ROI is going to be much higher and the conversion will make much more financial sense. The 8th way to protect against inflation is to delay Social Security to maximize the payout. If you're enjoying the content of this video, please subscribe. Click the notification bell and the like button. The success of the channel depends on you, so if you have any feedback or questions, please leave them in the comments. The final 7 ways to protect against inflation are all related to keeping your money invested. Your savings and assets can be decimated by inflation just as easily as your income, arguably even more. While most of your income is going to be used in the immediate term, your stock of assets are probably not going to be drawn on for 20, 30, or even 40 years depending on your age. If the value of your assets can't at least keep up with inflation, you can lose a staggering amount of purchasing power. For example, if your returns average even 1% less than inflation over a 30-year period, a nest egg of $1 million will be able to buy only $747,000 of goods and services. That's a loss of $252,000 in purchasing power. It is vital that your assets increase faster than inflation. And for this, here are 6 investments that can help you do just that. First, lend your idle cash through peer-to-peer lending. If you're holding significant amount of cash and you're only earning 0.5% on your money, keeping it in a high-yield savings account, you're actually losing money in terms of purchasing power. Purchasing power is the amount of goods and services that you can buy with that money. If the cost of living goes up by 5%, but the quantity of your money only goes up by 0.5%, you've lost 4.5% in terms of purchasing power. A possible solution is to lend your excess cash on a peer-to-peer lending platform such as Upstart, Prosper, or Lending Club. You can earn significantly higher returns, but you'll have to accept a higher risk involved in being the lenders, so make sure you do your due diligence. The 10th way to protect yourself against inflation is to invest in stocks. According to Yale professor Robert Shiller's historical returns data, the S&P 500 has returned 7.63% in real terms over the past 100 years. In other words, your purchasing power increases by 7.63% every year, which is great. In general, you have 2 options to invest in stock. The first is to buy an index fund or an ETF or a mutual fund. For many people, this is the best option because it's cheap and you can expect to get something that's close to that 7.63% annualized return. The other option is to buy individual companies. This takes more effort and offers the potential for higher returns, but it also comes with higher risk. When buying single stocks during inflationary periods, you want to focus on companies that have pricing power, which consists of 3 main components. The first component is a strong brand. Companies like Apple, Microsoft, Coke, and other iconic brands will be able to pass higher costs onto the consumers without reducing sales volumes much. In other words, they'll be able to maintain their profit margins, which will allow their stocks to generate better returns over the long run. The second component of pricing power is relatively few substitutes for their products. And the third component of pricing power are high switching costs. Switching costs are costs incurred by a business to switch from one provider to another. The higher the switching costs, the more operationally and/or financially expensive it is to switch. This reduces the probability that price increases will get rejected. Examples of switching costs include time to find another provider or work out a contract for their products and or services, effort or manpower required to integrate or configure the products and services of the new provider, lost productivity due to employees having to learn new processes, systems, and programs, and fees. It is quite common for there to be fees due when a company terminates a contract with a provider, and it's kind of like the fee that we have to pay to get out of a cell phone contract. The next thing I want to focus on while investing in individual stocks during an inflationary environment is a highly fixed cost structure. In general, the higher the percentage of fixed costs, such as machinery, buildings, etc., compared to variable costs, which are items like headcount, supplies, materials, and so on, the less of an impact rising input prices will have on their profitability in the immediate term. Review the financial statements and dig into their business model to assess their cost structure. The third and final thing you want to focus on while investing in individual stocks during an inflationary environment is a low cost of distribution. This is similar to the highly fixed cost structure, but instead of focusing on whether their costs are highly fixed or not, it focuses on their marginal cost of production, or the cost to produce one more unit. If it costs a fraction of a cent to distribute the product or service, like it does for software companies, then inflation will tend to have a smaller effect on their cost of production than companies that produce items that have high marginal costs, like cars, houses, machinery, etc. Now, I'm not saying that automobile, housing, or industrial companies will not do well during inflation. It all depends on industry dynamics and whether each individual company can maintain or grow their margins by controlling their costs. Having a lower marginal cost of production will only help. The last thing I wanted to point out is that it's often wise to focus on dividend-paying stocks during inflationary periods. Cash flow is king when inflation is high due to the time value of money. The time value of money is the concept that a dollar earned now is more valuable than a dollar earned in the future. It is especially true during times of rising costs and/or higher interest rates. Dividends can help meet living expenses or reinvest and grow your savings over time. This is not to say that you can't or won't lose money on dividend-paying stocks during inflationary times. You definitely can, but a dividend is only going to help. This takes us to the next investment option to help you beat inflation, and they also tend to pay high dividends, and that is REITs, or real estate investment trusts. REITs are companies that invest in a portfolio of real estate and are required by law to distribute at least 90% of the taxable income each year. Because of this distribution requirement, REITs tend to have much higher payouts than ordinary dividend-paying stocks. You can get yields of 5, 7, or 10 or higher percent depending on the specifics of each trust. This is why I always have a chunk of my savings in REITs. They provide strong cash flows, and this can be very helpful in your quest to protect against inflation. One drawback of REITs is that their distributions usually don't meet the requirements of qualified dividends. Instead, they're taxed at ordinary income rates rather than the lower capital gains tax rates. And because of this, it's usually better to hold REITs in a tax-advantaged account such as an IRA. The 12th way to protect against inflation is through real estate and or land. Historically, real estate tended to trend with the rate of inflation, but since the mid-1990s, it has taken off. In general, real estate helps you protect yourself against inflation over long periods of time. It tends to lose purchasing power during recessions and regain it during expansions. If you hold it for long enough, it's very likely to beat inflation. Of course, it depends on the price you pay for the property. Other than being an inflation hedge, real estate offers many advantages for growing your financial wealth. However, it also has several disadvantages. I'm not going to go through all the advantages and disadvantages in this video because it's already getting long, but if you're interested in learning about them, you can check out my article at adaptablewealth.com. You can find the link at the top of the screen. The 13th way to protect against inflation is through commodities and natural resources. We're currently in a transition phase where how we produce and consume commodities, energies, and other natural resources is changing. We are reducing our use of high carbon energy in an attempt to combat global warming, which means that demand for solar, wind, hydroelectric, natural gas, and nuclear energy will continue increasing. We are also moving towards electric cars, which means the demand for industrial metals such as lithium, copper, silver, nickel, and cobalt will continue increasing. I expect energy and commodity prices to remain elevated for the foreseeable future as we go through this transition, so they could be a pretty good place to store some of your wealth to try to beat inflation. But most of these investments are trendy right now and have logged large gains over the past couple of years. And even though I expect interest and therefore the prices to grow for the foreseeable future, it may be smart to wait for a pullback before buying in. The 14th way to protect against inflation is through alternative currencies such as gold, silver, and cryptocurrencies. And for me, that's specifically Bitcoin and Ethereum. Since 1968, gold has trounced the CPI while silver has tracked it very closely with a couple of spikes here and there. In other words, gold has increased your purchasing power while silver has supported it. I didn't include Bitcoin or Ethereum because they've only been around since 2009 or 10, and I wanted to show a long-term trend. We all know how well these two cryptos have performed over the last 12 years. They've blown away all other assets. Unfortunately, we can't guarantee that they will blow out all other assets over the next 50 years or even 12 years. However, expected returns are high given the pending adoption by corporations, banks, and investment firms. And the 15th and final way to protect against inflation is through Treasury inflation-protected securities, also known as TIPS. These are U.S. government bonds that pay a fixed rate of interest. The difference is that the principal amount is adjusted up or down depending on the CPI measured inflation rate. One word of caution is that just because you get a base rate plus the CPI doesn't mean you're fully protected against inflation. As I demonstrated in my other video, the CPI understates the true increase in the cost of living. Additionally, inflation rates are personal. Your inflation rate could be higher or lower than the CPI. And all of this is to say that although TIPS may have a built-in CPI adjustment, they're not a guarantee to fully protect against inflation. I do agree that they offer more inflation protection than non-inflation adjusted bonds do. However, saying that one investment is a better way to protect against inflation than another investment is different than saying that an investment protects your standard of living from inflation. And there you have it, 15 ways to protect against inflation. There are several actions on this list that everyone can take. I suggest finding your sweet spot between the benefit and the time needed to accomplish. Once you've found the ones that work best for you, start immediately. Rising prices affect us all and they don't wait for anyone. You're either actively working to protect against inflation or inflation is literally picking your pocket. Your time and your energy are being stolen from you. The good thing is you can take it back or at least some of it. If you want 15 more ways to protect against inflation, please check out the second part of this video by clicking on the thumbnail on your screen. And please don't forget to subscribe. Until next time, you all take care, and remember, wealth is not only about money and things. Your time and health are just as important, and working to improve all three pillars of wealth is key to being adaptable, resilient, and thriving in life.